After much speculation, Russia's President Vladimir Putin has declared an all-out war on Ukraine yesterday. This is a human tragedy in Ukraine, and I do hope that this war can be resolved quickly. In the meantime, the market saw significant volatility, with broad US stock indexes down substantially upon the news. However, by the afternoon, it was a different story as all three major stock indexes staged a massive rally, with the Nasdaq closing up more than 3% for the day. In this video, I'll be highlighting several assets and stocks which you can include in your portfolio to war-proof it. Do stay on to the end of this video where I'll highlight my 4 preferred ETFs to war-proof my portfolio. As usual, do note that the counters highlighted in this video are for educational purposes. Do engage in your due diligence work. Now, let us start building up the defense around our portfolio. Hello everyone, welcome to another episode of Financial Tidbits here with me, Royston at NAOF. Well, the talk of the town yesterday is Russia invading Ukraine. What in the world is Putin thinking? Well, just like in the clip, Putin will likely keep everyone on their toes in the coming weeks. I'm not here to discuss the various scenarios that might pan out concerning the Russia-Ukraine crisis, but to provide some suggestions as to how one can look to soften the impact on your portfolio if this war is to persist. Without a doubt, the stock market will take a nosedive if an all-out war is declared, as we have seen yesterday. However, there will be some asset classes as well as industries that will do well amid heightened war tensions. First up, it's gold. Gold has been a laggard in 2021, but its share price has seen a strong rebound of late, and the counter is currently at its highest level over the past 1 year. Gold is typically seen as a safe haven asset, one which investors flock to in uncertain scenarios just like the current one. While it is at a 1-year high, there is a possibility that gold could continue to rise and take out its all-time high level of $2,070 per ounce that we saw back in 2020. This is not just about war. This is also about inflation, and rising inflationary news has also been hitting the headlines all over the world in 2022. Gold is primed to finally play catch-up, and I will share a leveraged approach to gold exposure at the end of this video. The second category of assets one should look at is energy stocks. Now, oil prices are already looking to breach the US $100 per barrel mark because of the Russia-Ukraine conflict. Why so, you might ask? This is because Russia is a major exporter of oil and natural gas supplies to the world, and if the whole world is looking to sanction Russia, they will hit back by curtailing their oil and natural gas export. This will naturally drive up both oil and natural gas prices and consequently also the dreaded inflation figure. One could look to partake directly through oil and natural gas futures or indirectly through the stocks of energy companies such as ExxonMobil, BP, Petrobras, etc. The third category is defense companies. These stocks are typically favored upon when nations go to war. Stocks like Lockheed Martin, ticker LMT, Raytheon Technologies, ticker RTX, Northrop Grumman Corp, ticker NOC, and General Dynamics, ticker GD, are companies that will benefit from an increased government budget allocation to the defense sector as a result of war. These stocks have all done decently well and holding up strong on a year-to-date basis when the overall market is already in correction territory. Valuation-wise, these stocks are highly profitable companies and are not trading at eye-popping valuation levels compared to their growth counterpart. In a flight to safety environment, these companies will be favored when investors rush for the exit and exit their growth for value counters. The last category is short-term bonds. I understand that in the rising rate environment triggered by inflationary pressures, bonds typically will not do well. But there's now an opposing force, which is investors' preference for safe haven assets. And thus, despite the negative rate rise outlook, certain bond categories will still be favored upon. Shorter-term bonds with inflation protection could be an asset class that will benefit from investors' preference for safe haven assets, while being less impacted by a rising interest rate environment. Before I bring to your attention some potential ETFs to consider wall-proofing your portfolio, do note that many of these assets such as energy counters and gold have already appreciated from their lows. Now, some people with a magical crystal ball in front of them would say that you should have bought energy here at a low or gold when it's trading here at a low. But seriously, hindsight vision is always perfect. I believe that even without a prolonged war effect, both gold and energy still have the potential for more upside in 2022. Now, to gain exposure to the above 4 categories of investments, namely gold, energy stocks, defense stocks, and short-term bonds, one can look at these few ETFs that I'm proposing. First up, to have leverage exposure to gold, one might consider the GDX ETF, which is the VanEck Gold Miners ETF. Gold miners are typically seen as leverage plays to gold. This ETF is one of the largest gold miners ETFs out there, with its top 2 holdings in Newmont Corp and Barrick Gold. To have exposure to energy stocks, one can take a more diversified and safer approach, such as through the Energy Select Sector SPDR Fund, ticker XLE. This ETF holds some of the largest blue-chip oil companies in its fund, with Exxon, Chevron, and EOG Resources being the top 3 holdings in this ETF. Next up are defense stocks. The easiest way to buy a basket of defense names is to look at the iShares US Aerospace and Defense ETF, ticker ITA, which has a market cap of about 2.4 billion. This ETF mainly purchases your larger cap defense companies, those which I've highlighted earlier. For those who have a higher risk appetite, you might want to consider getting into the XAR ETF, the SPDR S&P Aerospace and Defense ETF, which focus on smaller cap defense stocks that have proven to be better outperformers over the long run versus ITA, but recent drawdown has been more excessive. For our last category, we look at inflation-protected short-term bonds. The largest in this category is the Vanguard Short-Term Inflation-Protected Securities, ticker BTIP, which has net assets of almost 60 billion at present. This ETF surprisingly also has a dividend yield of 4.7%. I hope that you have enjoyed this short sharing session on how you can war-proof your portfolio amid the Russian-Ukraine crisis. While we fret over how red our portfolio currently is, do also be mindful that there are many unfortunate and innocent Ukrainians that are caught in this unnecessary crossfire. Do pray for them. Please hit the like button if you enjoyed this video, share them with your buddies, and subscribe to the NAOF YouTube channel to enjoy more of such financial tidbits up ahead. Do also check out my other videos such as the one on inflation and interest rate hikes, where I introduce 4 ETFs to combat against the rise of inflation and interest rate risk. With that, this is Royston signing out.